This video is for educational and informational purposes only and should not be considered financial advice. Any analysis of Novo Nordisk is based on publicly available information and my own assumptions. Hi, I'm John and welcome to Nordic Value Investor. On this channel, we focus on long-term, value-based stock investing and company analysis. In today's video, we're doing a value investing analysis of Novo Nordisk, one of the largest Nordic companies, and it's gonna be a three-part series. I apologize for the sound quality of this video and for me changing microphones throughout. This is my first ever YouTube video, so apologies for that. The numbers I'm gonna be using throughout this video are in Danish kroner because Novo Nordisk is a Danish company. You can use dollars if you prefer using dollars. I should also note that the numbers I'm using are in millions. Yeah, so as you can see in the table, we are gonna look at sales, earnings per share, dividend, book value, operating cash flow, and free cash flow. All of these numbers are taken from quickfs.net. We are looking at all of these items from 10 years ago, from 2015 until 2024. We want to see an upward trajectory in these numbers, and when we convert them into a line chart, we clearly see the upward trend we're looking for. Next, we also want to examine the annual growth rates in percentage terms, where we ideally want to see figures of 10% or higher. Firstly, looking at sales, we see that over the last 9 years, sales have been growing 12% annually in average. For the last 5 years, 19% annually. For the last 3 years, 27%. And for the last year, 25%. All above 10%, which is good. For earnings per share, the numbers are between 14 and 30%. For dividend, between 17 and 36%. For book value, between 15 and 36%. And for operational cash flow, between 11 and 30%. The numbers are all above 10%, but the annual growth rate has declined from 30% over the last 3 years to 11% over the last year. Then we have to ask what could be the reason for that. And if we look at Novo Nordisk's cash flow statement on Siegen Alpha, and I choose Siegen Alpha because they show more details in their cash flow statement. There we can see that the main reason is a large drop in the line called Other Operating Activities, which fell by more than 12 billion crowns. This typically happens because of higher taxes paid, currency effects, and one-off items or provisions that affect cash flow, even though the underlying business is strong. It's important to note that capital expenditure does not reduce operating cash flow because it sits in investing activities, but the expansion projects behind the capital expenditure can also still influence operational cash flow indirectly. When Novo builds new production capacity, they often face higher operating costs, startup expenses, and new provisions or adjustments in the short term. These operational side effects can show up inside operating activities and temporarily hold back operating cash flow growth. Free cash flow has grown by 9% the last 9 years, by 14% the last 5 years, by 15% the last 3 years, and has declined by 11% the last year. That's because our free cash flow has declined from being 83 billion in 2023 to being 73 billion in 2024. That means that free cash flow has decreased by 9 billion from 2023 till 2024. The reason for this, if we look at the cash flow statement, is that capital expenditures rose by 21.4 billion, while operating cash flow only rose by 12 billion, and that gives us free cash flow that is down by 9 billion. So the main reason is that capital expenditures increased much faster than operating cash flow. And there's one major structural explanation for this, and that is a massive investment program to expand production capacity. Novo is building and expanding facilities in Kalundborg, Clayton, USA, Fremont, USA, multiple expansions in France and Ireland, a new fill finish capacity, GLP-1 production lines, etc. This is because global demand for GLP-1, Ozempic and Wegovy exceeds supply. To grow sales, Novo must invest in new buildings, sterile fill finish lines, biologics production modules, and API capacity. All of this is capital expenditures, which directly reduces free cash flow. Capital expenditure can be split into two: maintenance capital expenditure, which keeps production running, and growth capital expenditure, which expands capacity. And it is especially growth capital expenditure that has exploded for Novo. So free cash flow is falling, not necessarily because operations are weaker, but because they are investing heavily to support future growth. So in conclusion, we can say that Novo Nordisk's decline in free cash flow is caused by massive capital expenditure expansion to meet global GLP demand. The next thing we are going to be looking at is the return on equity. Return on equity tells us how much the company makes compared to the money the owners have invested in the company. It answers the question, for every $1 of shareholder money, how much profit does the company generate? The formula for calculating the return on equity is taking net income divided by average shareholders' equity and then multiplying by 100 to get it as a percentage. The reason for taking average shareholders' equity is that return on equity should reflect the equity the company used throughout the year, not just at one moment. When taking net income for 2024, it shows how much the company has earned throughout the year, whilst equity in our balance sheet only gives us a snapshot in time. It shows how much the equity was at the end of 2024. So looking at the balance sheet, we take equity at the end of 2023 and equity at the end of 2024 and divide it by 2. And that's how you get average equity throughout the year. And again, the numbers I'm using are in millions. That means the net income is 100,988,000,000. We take that and divide it by 125,023,000,000 and multiply it by 100 to get it in percentages. This gives us a return on equity of 81%. And for the last couple of years, Novo's return on equity has been around 70, 80, 90%. This means that for every $1 of equity in the company, we have 81 cents of net income in the company. A return on equity of 81% is extremely high. In general, we want to see a return on equity above 10%. When it's at 15 or above, it's very good. So why is Novo's return on equity this high? It shows that Novo Nordisk doesn't need too much equity in order to produce earnings. Different industries do have different return on equity in general. You don't expect the same return on equity for every industry. In the pharmaceutical industry, return on equity of 15 to 20% is normal. So 81 is also extremely high in this context. Both Novo Nordisk and their biggest competitor, Eli Lilly, are outliers in this regard. And this reflects that there's an extraordinary profitability for their GLP-1 drugs in the weight loss drug market. So the reasons for Novo Nordisk's return on equity being this high are 1. Extremely high profitability, 2. Very high operating margins, 3. Massive share buybacks, which reduces equity and therefore increases return on equity, and 4. Low capital requirements. They don't need huge investments to generate profit. A high return on equity can be the result of high profitability, which is good, but it can also be the result of huge debt, which is bad. If a company, for example, has huge loans, this can increase return on equity, not because net income increases, but because debt-funded buybacks or losses can reduce equity. Therefore, we always need to look at a company's debt level too. And first off, we're gonna look at debt to equity. In part 2, we'll examine Novo Nordisk's balance sheet, debt levels, and key valuation multiples.